Today we're discussing the pros and cons of borrowing against your portfolio versus selling your assets. First, the pros of borrowing against your portfolio. Number one, you avoid capital gains taxes. One of the biggest advantages of borrowing your assets instead of selling is that you don't trigger a taxable event because debt cannot be taxed. So if you've held an asset for years and it's appreciated significantly, selling it could give you a huge tax bill. Second, it keeps your investments growing. So your portfolio stays invested, compounding over time. This is crucial during bull markets. Why cash out when your money could keep growing for you? Third, lower interest rates compared to other loans. Security-backed loans often have lower interest rates compared to personal loans or credit cards. For high net worth individuals, the rates can be incredibly attractive and sometimes even lower than mortgages. And number four, flexible repayment options. Many of these loans have interest-only payment options, giving you more control over cash flow. Unlike traditional loans, some lenders don't require immediate principal repayment. So here are the cons of borrowing against your portfolio. First, margin call risk. If the market drops, you might be forced to add more collateral or sell assets at a loss. Imagine borrowing against stocks at their peak. If they crash, you can owe more than what's left in your account. Second, interest costs add up. Even at a low rate, the interest costs accumulate over time. If you're not reinvesting the borrowed funds wisely, the cost may outweigh the benefits. Number three, usage restrictions. Some lenders limit on how you can use the funds, like restricting investments in certain assets. If you're looking to start a business or invest in real estate, check the term loans first. Now we're going to speak about when it makes sense to borrow against your portfolio. First, need short-term liquidity without selling investments. If you need cash for a short-term opportunity, but you don't want to disrupt your portfolio, this can be a solid option. Second, want to avoid capital gains taxes. Instead of selling an asset and paying taxes, you can borrow and repay later when it makes financial sense. And third, have a diversified portfolio and a repayment plan. If you have a mix of assets and a clear plan to pay back the loan, the risks become much lower. So now let's talk about when to avoid borrowing against your portfolio. First, your portfolio is concentrated in volatile assets. If your investments are in high volatility like stocks or crypto, a downturn could force you to sell at the worst time. So this is where I would recommend an annuity, because with an annuity, you're able to lose no money. Second, no clear repayment strategy. Borrowing without a plan is very dangerous. You don't want to get stuck in a cycle rolling all over debt. And third, using leverage for speculation. If you're borrowing just to bet big on another investment, please be careful because this can wipe out your portfolio fast. So before making a decision, weigh in the costs, the risks, and the long-term financial strategy. Thank you so much for watching. I really hope you got some value from this video. If you're able to follow me on my social media platforms down below where I post more short-form content, and if you're interested in something that's risk-free and not volatile at all, please make sure to DM me or book a consultation with me down below.